Preparing for a financial analyst at Generali interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial analyst at Generali? Generali appeals to me because it combines a major international insurance platform with a clear long-term role in protecting customers and investing responsibly. I want an analytical position where financial reporting, forecasting, and business performance genuinely influence decisions. My strengths are structured problem-solving, attention to detail, and communicating conclusions clearly. I would be especially motivated by analyzing insurance profitability, capital, and investment results while learning how a leading insurer balances growth, resilience, and shareholder returns. While answering, connect your analytical skills to insurance, Generali's international footprint, long-term savings and protection mission, interest in financial performance, and motivation to support disciplined, data-driven decisions. Question 2. What do you know about Generali's business model? Generali earns premiums by providing life, health, and property and casualty protection, then pays claims and benefits when insured events occur. It also manages substantial investment assets, so returns, interest rates, and asset-liability matching are important. Profit depends on underwriting discipline, expense control, claims development, investment income, and capital efficiency. Its scale and geographic diversification provide resilience, but they also make consistent reporting, risk governance, and comparable performance analysis especially important for an analyst. Make sure to cover life and property and casualty insurance, premiums and claims, asset management, investment income, distribution, geographic diversification, and how underwriting and investment performance jointly influence results. Question 3. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and profit for a period. Net income flows into retained earnings on the balance sheet, while the cash flow statement reconciles that profit to cash through operating, investing, and financing activities. For an insurer, premiums, claims, investment income, and changes in technical provisions affect earnings, while investments and insurance liabilities dominate the balance sheet. I would always reconcile movements across statements rather than analyze any one report in isolation. In your answer, explain the income statement, balance sheet, and cash flow statement, then link net income, working capital, investing activity, financing activity, retained earnings, and insurance-specific balance sheet movements. Question 4. How would you analyze Generali's quarterly performance? I would begin with premiums, operating result, net income, capital, and cash generation, comparing each with budget, prior year, and guidance. Then I would bridge movements by business segment, separating volume, pricing, claims frequency, severity, expenses, investment income, foreign exchange, and exceptional items. I would investigate material variances against source data, test whether trends are recurring, and summarize the main drivers, risks, and actions in a concise dashboard for management. Be sure to mention comparing actuals with budget and prior periods, separating volume, price, mix, claims, expenses, investments, foreign exchange, and one-off effects, followed by concise management-oriented conclusions. Question 5. What is International Financial Reporting Standard 17, and why does it matter to an insurance analyst? International Financial Reporting Standard 17 is the accounting framework for measuring and reporting insurance contracts. It uses expected future cash flows, discounting, a risk adjustment, and a contractual service margin representing unearned profit. Profit is generally recognized as services are provided, rather than simply when premiums are received. For an analyst, this improves comparability but requires careful interpretation of service result, assumptions, discount rates, and movement analyses instead of relying only on reported premium growth. Focus on International Financial Reporting Standard 17's measurement of insurance contracts, fulfillment cash flows, contractual service margin, risk adjustment, revenue recognition, comparability, transition, and implications for interpreting insurance profitability. Question 6. How would you explain the difference between International Financial Reporting Standards 17 and Solvency II? International Financial Reporting Standards 17 is primarily an accounting framework designed to measure insurance contracts and report financial performance. Solvency II is a prudential regime focused on financial strength, risk-based capital, technical provisions, governance, and supervisory requirements. They use different objectives, assumptions, and presentation conventions, so reported equity or profit will not directly equal solvency resources. I would analyze both, reconcile important differences, and avoid judging insurer resilience from accounting earnings alone. In your answer, distinguish accounting reporting from prudential regulation, explain profit presentation versus available capital and risk-based capital requirements, and mention why analysts should reconcile both perspectives. Question 7. What is the combined ratio, and how would you interpret it? The combined ratio equals the loss ratio plus the expense ratio and measures underwriting profitability before investment income. A ratio below 100% indicates underwriting profit, above 100% indicates an underwriting loss. I would examine accident year results, prior year reserve development, catastrophe impacts, reinsurance, pricing adequacy, and expense trends. A deteriorating ratio could reflect claims inflation or weak pricing, while an improvement may be temporary if driven by reserve releases or unusually low catastrophe activity. Make sure to define loss and expense ratios, explain the below 100% threshold, distinguish current accident year from reserve development, and consider reinsurance, catastrophe losses, pricing, and portfolio mix. Question 8. How do interest rates affect an insurance company such as Generali? Interest rates affect both investment assets and insurance liabilities. Rising rates can improve reinvestment yields and reduce the present value of long-duration liabilities, but they may also create unrealized bond losses and pressure policyholder behavior. Falling rates generally support bond valuations but reduce future income and can increase liability values, especially for guaranteed products. I would analyze duration gaps, asset-liability matching, hedges, solvency sensitivity, and the mix of life and non-life exposures. Cover asset yields, bond valuations, liability discounting, duration matching, reinvestment risk, guarantees, spread risk, solvency, and the different effects of rising and falling rates across life and non-life businesses. Question 9. How would you evaluate an investment portfolio's performance? I would start with total return, recurring investment income, and performance versus relevant benchmarks, then decompose results by asset class, duration, credit, geography, currency, and realized versus unrealized movements. I would also assess liquidity, concentration, impairments, and risk-adjusted return. For an insurer, absolute performance is not enough. The portfolio must support liability cash flows, maintain acceptable solvency, and remain resilient under market stress. That makes asset-liability alignment a central conclusion. Discuss benchmark relative returns, asset allocation, income, realized and unrealized gains, credit quality, duration, liquidity, risk-adjusted returns, currency, and whether performance supports insurance liabilities and capital objectives. Question 10. What is asset liability management, and why is it important for Generali? Asset liability management coordinates investments with the timing, currency, duration, and risk characteristics of insurance obligations. The objective is not simply to maximize portfolio return, it is to ensure claims and benefits can be paid while managing rate, spread, liquidity, and reinvestment risks. I would compare asset and liability duration, model stressed cash flows, review guarantees and surrender assumptions, and monitor mismatches. Effective AUM supports both solvency and dependable investment income. In your answer, explain matching asset cash flows and duration with policy obligations, managing interest rate and liquidity risk, considering guarantees and surrender behavior, and protecting solvency and sustainable returns. Question 11. How would you build a financial forecast for an insurance segment? I would build the forecast from operational drivers rather than applying a blanket growth rate. For non-life, I would model exposure, pricing, retention, claims frequency, severity, catastrophe assumptions, and expenses. For life, I would consider sales, persistency, mortality, expenses, investment yields, and contractual service margin release. I would then forecast capital and cash, incorporate scenarios, validate assumptions against history and business plans, and clearly document sensitivities and judgmental areas. Be sure to mention premium volume, pricing, retention, claims assumptions, expenses, investment income, reserving, capital, scenarios, historical calibration, and transparent documentation of key drivers. Question 12. A business unit misses its forecast by 10%. How would you investigate? I would first confirm the variance is real by checking definitions, data loads, accounting entries, and timing. Next, I would create a bridge from forecast to actual, separating volume, price, claims, expenses, investment markets, foreign exchange, and one-offs. I would discuss the drivers with the business owner, test whether they are temporary or structural, and assess forecast implications. Finally, I would communicate the quantified root cause and recommend corrective actions or revised assumptions. Focus on quantifying the variance, identifying timing versus structural causes, checking data integrity, separating controllable and external factors, engaging stakeholders, and updating forecasts with evidence rather than assumptions. Question 13. How would you assess the quality of an insurance company's earnings? I would distinguish recurring operating earnings from market movements, disposals, reserve releases, and other one-offs. I would examine whether underwriting profit is supported by adequate pricing and favorable claims experience, whether investment income is sustainable, and whether assumptions or discount rate changes drive reported results. I would also compare earnings with cash generation and capital creation. High-quality earnings should be repeatable, transparent, and supported by underlying business performance rather than accounting or market volatility. Mention recurring versus exceptional profit, underwriting quality, reserve development, investment volatility, assumptions, capital generation, cash conversion, segment consistency, and whether earnings are supported by sustainable operating performance. Question 14. What financial ratios would you monitor for Generali? For non-life, I would monitor the combined ratio, loss ratio, expense ratio, premium growth, and reserve development. For life, I would review new business value or margin, persistency, contractual service margin movements, and operating result. Across the group, I would track solvency, return on equity, leverage, liquidity, investment yield, and capital generation. Ratios need context. I would compare trends, peers, targets, and business mix before drawing conclusions. In your answer, include combined ratio, operating result, new business metrics, expense ratio, solvency ratio, return measures, leverage, liquidity, persistency, and investment performance, explaining what each reveals. Question 15. How would you use Excel to analyze financial performance? I use Excel to create transparent, controlled analyses rather than opaque calculations. I would organize source data, standardize definitions, use pivot tables and SUMIFs for segmentation, and use XLOOKUP or index match for controlled mapping. For forecasts, I would separate assumptions from formulas and include scenario switches, reconciliations, and error checks. I would also document sources and preserve version control. The final output should let a reviewer trace every material conclusion back to reliable data. Be sure to mention structured data, reconciliation, pivot tables, XLOOKUP or index match, SUMIFs, scenario analysis, checks, version control, and designing outputs that are auditable and easy for stakeholders to use. Question 16. How would you identify and prevent errors in a financial analysis? I prevent errors by combining process controls with analytical skepticism. I would validate source completeness, reconcile totals to the general ledger or approved reports, check period and currency mappings, and investigate unusual movements. In spreadsheets, I separate inputs, calculations, and outputs, use control totals, flag exceptions, and avoid hard-coded figures. I would request an independent review for important deliverables and document any judgment. If a discrepancy remains, I escalate it rather than silently adjusting it. Cover source validation, control totals, reconciliations, independent review, reasonableness checks, audit trails, formula protection, clear definitions, exception reporting, and escalating unresolved discrepancies promptly. Question 17. Tell me about a time you explained complex financial information to a non-finance stakeholder. In a previous project, a commercial manager questioned why strong premium growth had not produced similar profit growth. I replaced accounting terminology with a simple bridge showing volume, claims inflation, commission, and investment effects. I highlighted the two drivers management could influence and checked understanding through questions rather than delivering a long presentation. The discussion resulted in a pricing review and clearer monthly reporting. It reinforced that effective analysis means making the decision implications easy to understand. Make sure to use a specific situation, simplify technical language, focus on business impact, confirm understanding, describe your actions, and quantify the result or decision that followed. Question 18. Describe a time you handled conflicting deadlines and priorities. When two reporting deadlines overlapped, I listed the required outputs, dependencies, review time, and consequences of delay. I completed the regulatory sensitive analysis first, informed both stakeholders of the proposed sequence, and agreed a narrower interim version for the second request. I used a checklist and built in reconciliation time rather than sacrificing controls. Both deliverables were submitted on schedule, and the experience taught me to communicate constraints early instead of reacting at the last minute. Focus on prioritization by business impact and deadline, transparent communication, breaking work into milestones, protecting quality controls, and explaining how you delivered or renegotiated expectations. Question 19. What would you do if a senior manager challenged your analysis? I would treat the challenge as an opportunity to test the analysis, not as a personal criticism. I would revisit the source data, definitions, assumptions, and calculation, then explain the logic with a concise bridge. If the manager identified better information, I would update the work and show the impact. If my conclusion remained supported, I would state that respectfully, provide the evidence, and agree what additional validation would resolve the disagreement. Mention staying objective, revisiting definitions and assumptions, showing supporting evidence, acknowledging valid corrections, documenting changes, and standing by conclusions respectfully when the data supports them. Question 20. What questions would you ask us at the end of a Generali Financial Analyst interview? I would ask how success is measured in the first 6 and 12 months, which reports and decisions this role supports, and how finance works with actuarial, risk, investment, and business teams. I would also ask about the main data or reporting challenge the team wants to improve, the systems used, and opportunities to develop technical and commercial skills. Those questions show that I am interested in contributing quickly while building a long-term career at Generali. Be sure to ask about success measures, reporting responsibilities, systems and data, interaction with actuarial and investment teams, development opportunities, current analytical challenges, and the team's decision-making culture. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.